Welcome to The Explainer. Today, we are digging into a really popular strategy for making some extra income from stocks you already have in your portfolio. It's called the covered call.
So let's just jump right in. If you've ever looked at your portfolio on a day where the market is just flat and thought, man, I wish these stocks were doing something for me, then you've asked the right question. And one of the most common answers you'll find is a strategy called writing a covered call.
So what in the world is a covered call? I know the name sounds a little technical, maybe a bit intimidating, but the idea behind it is actually pretty simple once you break it down. Let's do that right now.
You can think of it like you're renting out your stocks. Seriously, you're selling someone the right, but not the obligation, to buy your stock at a certain price later on. And for giving them that right, they pay you a fee called a premium right up front. That cash is yours to keep no matter what.
Okay, so you knew there had to be a catch, right? This isn't exactly a free lunch. When you use this strategy, you're making a fundamental trade-off. And it's really important to understand this before you even think about trying it. You're basically swapping potential future gains for guaranteed income today.
So here it is, plain and simple. The good part? You get paid cash, instantly. That premium can even cushion your losses if the stock dips a little. The bad part? You're putting a ceiling on your profits. If that stock absolutely skyrockets, you don't get all of that upside. You're obligated to sell at the price you agreed on. Let's see how this actually plays out with a real example.
All right, let's get our hands dirty and make this real. We're going to use an example straight from our source material. Let's imagine you own 100 shares of Intel. You bought them for $32 a share. Now, you want to see if you can make a little extra cash from this position.
So here's the deal you make. You sell a call option, which is just a promise to sell your Intel shares for $34 each. That's called the strike price. And this deal is good for the next 2 months. Just for making that promise, someone pays you $1.50 per share right now, today. So, what happens next? Let's walk through 4 possible scenarios.
First up, let's look at the scenario every investor worries about. What happens if the stock price actually goes down?
Well, think about it. The person who bought the option from you is not going to buy your stock for $34 when they can just get it on the market for $30. So the option expires and it's worthless to them. You keep your stock and you also keep that $1.50 premium they paid you. So yeah, your stock lost $2, but the premium softened the blow. You're only down 50 cents instead of the full $2.
Okay, next. What if the stock does absolutely nothing? It just stays flat at the price you paid for it. This is actually where covered calls can be pretty awesome. Once again, nobody is going to pay $34 for your stock, so the option expires. Your stock didn't make you any money, but you still have that $1.50 premium. That's pure profit. You just made a 4.6% return in 2 months on a stock that didn't even move. Not bad, right?
All right, let's look at what many people would call the sweet spot. What happens if the stock goes up, but just a little bit?
Even at $33, the stock is still below your $34 strike price, so the buyer won't exercise the option. And look at this, you get the best of both worlds. You made $1 per share just because the stock went up, and you get to keep the $1.50 premium. This is a fantastic result.
And finally, the big one, the one you're probably most curious about. What if the stock does exactly what we all dream of, and it just takes off like a rocket? This is where that trade-off we talked about really comes into play.
Well, with the stock at $40, the person who bought your option is definitely going to use it. They get to buy your stock for the agreed-upon $34. You are forced to sell. Now, you still made a really nice profit, $3.50 a share, but you missed out on all that extra money between your sale price of $34 and the market price of $40. That's the cap we were talking about.
You know, when you lay it all out like this on a chart, it becomes crystal clear. You can see how you make money in most of these scenarios, and you reduce your losses when the stock falls. But you can also see that hard ceiling on your profits. That's the whole game right there.
Okay, so maybe you're thinking, this is kind of cool, but it also sounds like a lot of work to manage for every single stock I own. And you'd be right. That's why covered call ETFs exist.
And this is a really clever way fund managers approach it. They don't necessarily write calls on their entire portfolio. Instead, they might only cover, say, a third of it. This lets them generate that nice premium income from one part while leaving the rest of the portfolio uncovered, so it can still capture all the upside if the market takes off. It's all about finding that perfect balance.
And these pros aren't just setting it and forgetting it. They are actively managing this stuff. When the market is roaring, they'll set those strike prices higher to try and grab more of the gains. If the market's tanking,
They'll focus on just generating that consistent premium income to act as a buffer. It's a dynamic process.
Now, for all you do-it-yourselfers, there is a more advanced move. Let's say your stock is climbing fast, and you're starting to regret that you agreed to sell it so cheap. You can often roll the option. It basically means you buy back the option you sold and then immediately sell a new one that expires later and has a higher strike price. It's kind of like hitting the reset button to give your stock more room to run.
So we've gone through a lot, the good, the bad, the different scenarios. What's the final takeaway here? What should you be thinking about?
This quote from one of our sources just nails the dilemma, doesn't it? An 11% gain in 2 months is amazing, but there's always that little voice in your head saying, yeah, but you could have made more. That's the mental hurdle you have to be comfortable with.
And that's really the question you have to ask yourself. What do you value more? The guaranteed cash in your pocket today or the possibility of a much bigger payday down the road? There's no right answer. It all depends on your goals as an investor. Thanks for joining me for this explainer.